Good morning. Welcome. It is 6 a.m., half an hour before the market's going to open on Thursday, February 22nd. Yesterday, we had NVIDIA earnings that had a huge effect on the post-market session and up. It was up quite a bit, and it was helping the indices move up as well. So what we want to see this morning is whether or not that continued for the rest of the night. If NVIDIA continued, if the markets continued, and then what we want to look for is any divergence and what that might tell us. So let's take a look at our futures. And our futures are up. They're up quite a bit, very, very significantly in the NASDAQ. That is 2%, more than 2%. So that is definitely not random. And NVIDIA is definitely pulling the entire NASDAQ up. S&P is up quite a bit as well, 1.4, about 1.4%. So definitely not random. And again, being pulled up by NVIDIA. Now, that a single stock can have such a huge effect on such large indices, that is not a sign of strength. That is just one single stock propping up the entire market. So if we see any weakness inside of NVIDIA, especially today during the session, if we start pulling back, then these indices will start pulling back as well. That said, we are almost guaranteed, I can say with complete confidence, that we're going to have an update today. Our close today is going to be above the close yesterday, unless there's some crazy black swan event that happens today and takes us down. So that's still really great news for the NASDAQ and the S&P. And Dow is up about 50, about a little over half a percentage point. So it's definitely concentrated far more in the tech, and for obvious reasons. NVIDIA is obviously a tech stock, it's a semiconductor stock, and it's AI stock. So it happens to span all the hottest sectors right now with the AI revolution. So we talked a little bit about this last week, I think it was, how NVIDIA has gained over 500% over the past year. 400% over the past year, and that is extremely exuberant. This is starting to look more and more like the dot-com bubble. We're so early. So this is definitely a bubble, and we want to watch for signs of it getting really crazy and being on the verge of bursting. We're not there yet. I wouldn't even say that we're close to being there yet. But over the next year or 2 years, we really want to pay attention for signs of a bubble burst. We don't want to get overly exuberant about this. And then we want to learn from our history. We want to check out what happened in 2000 when the bubble burst. What sectors were affected? What sectors still did very well, if any? And we can start to plan and strategize so we can prepare ourselves and know what to pay attention to in the upcoming year to 2 years. That said, for now, everything is really great. Let's take a look at the daily view. And today, so it looks like we're going to open right at the all-time highs today on the S&P 500. So it's going to be a critical level. Yesterday and for maybe a few days, I've been talking about how this is a ascending triangle. And if we struggle at this all-time high right here, then we pull back to the trend line within a week and we test again. And at some point, these two are so close together, we are going to be forced to pick a direction. Either we break below the trend line or we go above it. But today is an excellent example of why we don't just turn around our portfolio because we're in a danger zone, or we think there's so many signs that we're going to break down. It's going to be so hard for this market to continue to move upwards. Well, it can move upwards until it can't. We don't want to jump the gun and move ahead of ourselves. So this is exactly why we hedge and we accept small losses for big protection. So that's going to serve us really well today. Our hedges are obviously going to lose money, but the maximum they can lose will not harm our portfolios in a meaningful way. What should happen is that our long positions should far outstrip the losses that we get from our hedges today. And then we can just take off the hedges for now. So but depending on the performance of our hedges and how we would design them, you might keep them on because we still don't know if we're going to make it above these all-time highs. The particular hedges that we talked about in these videos, however, were really only designed to protect us until Friday. And Friday, we're not going to break back down to the MA50. That's going to be too much of a drop in a single day unless you get a COVID-like event. So we can comfortably take off our hedges today and then allow our portfolios to do whatever they're going to do without the weight of the hedges dragging them back. We really want to pay attention to this all-time high, though. We really need to get above the all-time high comfortably, not just, hey, we went up above it during the day and then just came right back down. We want to get comfortably above it with some direction and momentum for us to say, okay, well, we're no longer concerned about this horizontal resistance, and then we can start waving higher. And then on the next pullback to the trend line, then we can hedge ourselves again. So this is probably going to be the same story for the Dow Jones and the QQQ. So we'll take a quick look, but everything that I just said, I'm probably just going to reference everything I just said in the S&P. So let's look at the QQQ. The QQQ, we did break below that trend line today, but both in the morning and afternoon sessions, I did caution like that this could just be, hey, we just pulled back a little bit further than expected and pop right back up, especially with the strong prospects of NVIDIA doing very well in their earnings and pulling the markets up, which is exactly what happened. And we're pulling up to not quite the all-time highs, but in the region of the previous high. So that'll be really interesting. What also would be really interesting is if we pull up to here where we're opening, and that is the high for the day. Because what would happen is we would have this high right here, then we pulled back, then we made this high right here, which was lower than the all-time high, then we pulled back, and then if we only pull up to exactly where we're opening, and then we start to fall again, then we will have a series of lower highs, and that last lower high would be very, very close to this trend line, and that would be a sign of weakness. So for the QQQ especially, if we're going to have a continuation of this trend, we really need to trade higher during the day and stay higher. So given that we are already 2% above the previous open, that's going to be kind of difficult, or at least moving significantly upward is going to be kind of difficult. The more likely scenario for a bullish case in the QQQ is that we trade to where we're going to open and we just go sideways for the rest of the day, if it's going to be bullish. And then if it's going to be not so bullish, it's still going to be bullish no matter what because of that huge gap up. But what is going to be the less bullish scenario is we open up here and we start trading down, especially if we trend back down, all the way back down to the trend line. That would be not bullish at all. I couldn't call it bearish, but it would be a very, very strong sign of weakness within this bullishness. So Dow Jones is looking very similar to the S&P 500. So everything I said about the S&P 500 is going to apply to the Dow Jones. What we want to see now, so we have consistency with NVIDIA moving up and QQQ moving up and S&P moving up, and to a lesser extent, the Dow Jones moving up. which still makes sense. That's still consistent because we don't expect tech to have a huge effect on industrials or the more defensive sectors. So the fact that Dow Jones isn't being affected nearly as much as the S&P 500 and the QQQ is not a surprise. So everything is still consistent there. What we want to see is if there's an associated move with the bond market. Probably not, because the bond market doesn't affect or isn't affected or isn't really affected, isn't really affected by the equities market. However, the bond market does have a strong effect on the equities market. So it's a one-way relationship. It doesn't go both ways. So it's going to be extremely unlikely that we see an associated move going up in the TLT. And if we did, there wouldn't be a causal relationship. It wouldn't be because, hey, Nvidia's up and so bonds are gonna go up. If anything, Nvidia's up and it sucks money out of bonds. And so because people are, hey, let's put some cash out of bonds and start investing it into Nvidia. Although if you're a professional and you did that, you would lose my respect. So we'll see. We'll see what's happening with TLT. They will have responded and reacted to the FOMC minutes yesterday. So we had both NVIDIA and FOMC minutes on the same day. So any move that we see in the TLT is by far more likely going to be associated with those FOMC minutes. And we want to see, so if they did move in the same direction, then that would be bullish. That would be a bullish case. However, it's not really. So pre-market 92.36 when we closed at 92.18. So it barely moved. It barely moved overnight. It's nothing of significance. What is significant, however, is that yesterday this close and the low are below these lows right here. And let me see if I can zoom in and make that more clear. Okay, so this close is below that low right there, that low right there, that low right there is very clearly below the purple line. And the low is obviously lower than that. But more significantly, we broke below that MA90. And if I adjusted my MA90 to an MA100, depending on the institution, they'll use either 90 or 100. So we're right on top of the MA100. So we haven't broken the MA100 yet. So not super significant yet, but it is significant that we did make it below the MA90. If we continue to move lower and break that MA100 as well, that's going to be very bearish. That's going to be bad news for the markets. So for now, we're safe. And if we look at all of our indices, QQQ is going to reach another decision point very soon. We talked about that squeeze between the all-time high and the trend line. And the QQQ it doesn't have that much more space for it to run. Just like the S&P also doesn't have that much more space to run, but QQQ just has a little bit less time for that decision point. So we are going to revisit this trend line most likely very soon within the next week. So we're just going to enjoy either some sideways trading or we'll be able to break above that all-time high. But if it's sideways trading, we're going to revisit. And the likely direction at that point depends on your perspective. So every time we come and we touch and challenge this trend line, we have a roughly 70% chance that we're going to continue the trend, which is why we always point our portfolio in the same direction of the trend and hedge ourselves if we break, in case we break. But this would be the seventh time. It will be the seventh time we test that trend line. And from a longer perspective, the more times we test it, the more likely it is that we're going to break through it. And given all of the forces against the markets continuing higher at this point in time, it, it could be the time that it breaks. But for me, I would be much more strongly convinced of that if we had reached the second psychological resistance. It doesn't have to. It doesn't have to. This is plenty of movement already from the low. If we go from, I need to move this out of the way. So 23%, that's plenty. That's plenty of move. That's plenty for the market makers. That's plenty for them to start running out of cash. So we could just move down at the next test, but I would be more convinced of it if we hit this second psychological resistance. And really, we're not terribly far away. We're going to open around 504, 6 points on the S&P 500. Our daily ATR is 4.5. So it's conceivable for us to reach the psychological resistance in 2 days. So we'll see. What we would want to see for that to happen is strong movement upwards during the day. So given the gap up, the more likely scenario is chop or pulling back towards the previous close. Or so at the very least, initially, we have 70% chance that we're going to pull back towards the previous close, and then we might bounce from there and then chop sideways, or we will get directionality and a strong move upwards, which is what we need for the continuation of the trend. So instead of just choppy movement sideways. So if you're day trading, that's what I watch for, but I wouldn't get too excited if we start pulling back. If we start pulling back with strength and conviction, and we break that first psychological level at 500, so we trade down about 4 points, then that would be more of a bearish intraday. I'm talking just day trading. That would be more of a bearish case. And then if we go back up towards if we break these overnight highs at 504.5 with conviction, and then if we break 506, that would be more of a bullish case. Personally, I wouldn't day trade today. I would there's going to be, unless I wanted to stare at the screens all day long, I wouldn't day trade today. There will be volatility, and there will be people like, oh, gap up, let's trade it down. And then those people, depending on how the market makers are feeling and themselves personally, they could get trapped into a bear trap. And then the people who are enthusiastic, look, this market is so strong, nothing can stop it. And then we start trading up, and then the market maker bull trap, and then we take everything down. That is why we have a likely sideways motion today. We're just going to end up closing in a similar area of the open, or at least we're going to spend a significant amount of time around the level of the open, because there will be plenty of times for people who are over exuberant and people who are expecting a crash for the market makers to set up traps. And I would expect to see multiple bull and bear traps today and us end up being sideways. I could be totally wrong, or at least that happening for the first several hours of the day. And then at the end of the last hour or so, we start to see some directionality. So be very, very careful if you're day trading. If you're really good at spotting the traps, go ahead and day trade. If you're not good at spotting the traps, then just stay out of it. That's my opinion, at least. So just a quick summary, we're still pointed upwards. Our portfolio should still be pointed upwards. At this particular moment in time, we're not really concerned about hedging. And the hedges that we talked about in these videos were only designed for Friday. So today is a great day to take them off. You could wait till tomorrow, but today is an appropriate time to take them off as well. We'll see how the session develops. We'll see if I'm right about having a whole bunch of bull and bear traps and then ending up sideways, or at least getting directionality in the last hour of the day. And we're going to start paying attention to the entire AI bubble and looking for sectors to, on a longer term, to pay attention to. Have a wonderful day and a profitable session, and I will see you in the aftermarket.